Good morning. It is Thursday, December 11th. I'm Vincent Fanvan, and this is Always Booked Live. This is your daily briefing to keeping your calendar and your pipeline always booked. On today's show, the Federal Reserve just cut rates again, and it warned that it's actually going to be hitting pause. What that means for you and your borrowing costs, as well as the cash flow planning for the rest of the year. Then small businesses are raising prices at record rates right now as inflation roars back, forcing tough decisions on what to take. AI adoption just hit 68% among small businesses, with most adding workers, not actually cutting them. Plus, we're going to be covering the holiday spending trends, surprising retail strategies, and why nearly half of all business owners say that their inflation is still their biggest challenge. But first, the Fed just cut rates. If you're counting on cheap money in 2025, you might want to rethink that plan, though. Let's start with the Federal Reserve, which cut interest rates by 1/4 point yesterday, but it made it really clear that this could actually be the last cut for a while. If you've been waiting for easier access to capital or lower payments on your business loans, credit lines, or equipment financing, today's news is both good and bad for small business owners. The Federal Reserve lowered its benchmark rate to a range of 4.25 to 4.5, making it the third consecutive cut since September. That's according to the Wall Street Journal. But Fed Chair Jerome Powell actually signaled that the central bank is now adopting a wait-and-see approach, with officials actually really deeply divided about whether to cut rates further in 2025. The New York Times reported that the Fed's updated economic projections show that policymakers only expect 2/4 point cuts next year. That's down from the original 4 cuts that they had just forecasted 3 months ago. Inflation remains stubbornly high above the Fed's 2% target, and officials are worried that the continued rate cut could actually reignite pressure on pricing. At the same time, the labor market has cooled, but it's remained, for the most part, pretty resilient, leaving the Fed in a difficult position as it tries to balance supporting growth without fueling inflation at the same time. Back on to today's show, we're bringing on Spencer Donaldson, CEO and founder of Captive Demand and FirstFuture.ai. Spencer, I know you've run a lot of capital-intensive businesses in the past. If you take a look at something like the meal prep planning company that you started, how important was capital to being able to run your operations then? And how would you think about capital today in this environment with this announcement from the Fed?
I mean, capital in any business that's resource heavy, where you need to carry inventory, is always a huge concern. So, for a business like that, you're looking for those rate cuts. And so, obviously, even in construction and things like that, a lot of the businesses are going to be pulling back without those rate cuts. I mean, I know he made some good points in his speech about where things are, and he's kind of solely looking at it based on the housing market and what the rate cuts mean to the housing market, but it also affects a lot of other areas in business. So it's just going to keep slow growth in the economy. I mean, there's a lot of problems right now. So it's a challenge, and I wouldn't want his job. I'll tell you that much.
Yeah, I wouldn't want his job right now. You're damned if you do, damned if you don't, in terms of you're never going to please anybody. But, the job of the Fed is pretty clear, though, right? Try to keep inflation under control, try to maintain steady, and try not to let political pressures impact your decisions. But today, that's gone into everything. But the piece that we focus on this show is the so what. What does this actually mean to the small business owner? If you were in some of the seats running some of the businesses, you've scaled Inc. 5000 companies. Are you holding on to cash right now, holding them into treasury funds? Is now the time to actually invest and actually start making the big moves on expansion? I think the days in the past of being able to grab whether it's a $500,000 loan, $1 million loan, to be able to pay to feed into expansion, today marks basically a moment where we're saying, hey, if you're expecting the cash and the capital to become easier next year, that likely isn't going to happen. But how would you think about expansion and growth for somebody who's listening to this going, shoot, this actually puts a dent in my plan for 2026?
I mean, everything I'm doing right now is completely focused on what our net profit is. So we're focusing on things that can be highly profitable, cash heavy, focus on reinvesting our own money into our own businesses and scaling that way. I do think there is an opportunity to get to the market if you are investing. and pick up some deals. But the challenge is we don't know how long these issues are going to last, and neither do I. So I tend to focus on putting my money into conservative things and then being more risky in the things that I do. So I'm putting more capital behind everything that I'm doing. And so we're building new businesses and focusing on just maintaining our profits. But companies that run on thin profit margins, like a meal delivery company, are really struggling right now. And so those companies are going to continue to struggle. The only thing they can do is raise their prices, and their customers are going to have to eat that cost.
Yeah, and we're going to bring you back on and talk about raising prices in just a minute, because a significant number of small business owners are raising prices, and that's a clear trend of what's happening right now. And where to store that capital becomes even more important. I know on my company in the past, we would actually have some of our treasury accounts invested in the market, and we're going more conservative on that right now, putting it into high interest savings accounts, spreading our treasury accounts across multiple accounts so that we have an FDIC covered limit up to 250,000 on each one of those, of being able to hit the cap on a single account. We'll bring you back here in just a second to talk about more about small businesses that are raising prices, what to pass on to consumers, and what to eat as a margin hit for your business. And so when you take a look at the Fed rate cut from yesterday, what does this mean for small businesses? If you're planning to finance expansion, if you're planning to buy equipment, if you're planning on refinancing existing debt, today's cut gives you a slightly better window, but that window might be closing soon. For brick and mortar businesses like med spas, fitness studios, this might be the time to lock in those lower rates on leases and equipment before borrowing costs might actually go up again. And if you're running an online course or a coaching business and you rely on credit to be able to invest into your ads, into your funnels, into your technology, you need to plan for tighter conditions ahead. B2B service firms, agencies, professional services, especially if you're carrying a line of credit or an SBA loan, you want to use the next few months to shore up on your cash reserves and reduce your variable rate exposure. And, this is the big takeaway. Don't count on easy money in 2026. If you need capital, you need to move sooner rather than later. And, if your company has an opportunity to invest in something like a CRM or a client management portal that can actually automate collections, automate rebookings, rescheduling, payment reminders, now's the time to make that investment into that CRM, into that client portal, into that mobile app as you tighten up your cash flow so you're not dependent on external financing to be able to cover your gaps. Still to come, why small businesses are rising prices at the fastest rate on record and what this means for your pricing strategy. Small businesses have hit a record this year in 2025, and it's not necessarily a good one. Price hikes are back and they're bigger than ever. Now let's turn to inflation, which refuses to quit. The new data from the National Federation of Independent Businesses show that small businesses have raised prices in November at a faster monthly pace than the survey's entire history. And that has major implications for small business owners and how you price services in 2025. According to the NFIB's monthly business economic trends report, a net of 34% of small business owners have raised average pricing in November, and that represents a 13-point jump from October. That is the single largest single month increase since this survey has begun track. Fox Business reports that 39% of owners have raised prices and only 88% have lowered them. And that leaves a net surge that we haven't seen since March of 2023 when inflation was peaking. So this NFIB data, what does it mean? It also found that 30% of small businesses plan to raise prices again over the next 3 months, signaling that inflationary pressure isn't easing. And what's the culprit here? Culprit is rising material costs, higher labor expenses, persistent supply chain disruptions. 15% of business owners now cite inflation as their single most important operating challenge today, ranking second only to finding qualified workers. And so bringing me back onto the show, Spencer Donaldson, Adaptive Demand, First Future.ai. Spencer, what are you seeing right now? Are you seeing your vendors across the board doing pricing increases? And what are the strategies that you've seen some of your clients implement?
Yeah, I mean, everybody's raising prices. It's something that just has to happen. If there's inflation in the market, you got to raise your prices. We're raising our prices, and that's because everybody else is raising their prices. So unfortunately, someone has to bear the burden of that cost, whether it's your customer or it's you is the question.
And ultimately, somebody is going to take the hit there. When you take a look at the environment the small businesses are in right now, it's hard to hire. It's hard to hire. I mean, even with when we've seen like the thousands of layoffs from companies like Verizon, like Amazon, that are laying off workers, we have low unemployment rate right now. And in the market, it is hard for small business owners to be able to find all of the talent that they need to hire to be able to perform the services in their business. And if it's hard to hire, then that means there's one thing that you need to do. You need to raise your rates that you're paying. And ultimately, at the end of the day, that's going to result in the outcome like what you're talking about, where with supply chain difficulties as well as talent issues with raising prices, ultimately at the end of the day, you have to pass that cost on. Now, there isn't though of what is the messaging when you're doing that? What is the additional value that you're providing? I know I've seen your companies, as you're raising prices, your messaging is actually that you're delivering more value, which is true because a lot of the efficiencies that you've been able to gain with AI, not necessarily replacing workers, but just being able to have your human team be way more efficient to be able to deliver better outcomes for clients.
Yeah, and I think that is the key. It's like finding new ways. Luckily, we're in a period where AI is a thing and you can drive more efficiency than ever than what you could do in the past. So if you're going to raise prices, you have to find other things that you can do low cost to give your clients so they feel like they are getting an added service. That way it's not like, hey, we're just raising your prices to raise your prices.
Let's talk about what does it look like on the other side when you have your vendors that are raising prices? What are you doing to go back and be able to renegotiate those contracts?
Well, I mean, it just depends on volume. So a lot of the deals we're doing, we'll acquire, even if we're working with a client in our agency, we're negotiating deals with firms that own multiple companies, and we'll bundle deals. We'll do a discount on everything. So the more they buy now, the less price they're going to pay overall. That ensures that we have a good long-term business and keeps things afloat for us. But honestly, like when you're negotiating these things, ChatGPT is your friend, and it's actually been a really good help in negotiating with our vendors and figuring things out. So highly recommend just chopping it up with ChatGPT.
Yeah, 100%. I mean, on both sides, if you have vendors that are increasing the price that you're paying your vendors, or if your proposals are increasing, I love what you're talking about there in terms of the volume discount, where you work with an investor to be able to say, hey, we will, prices are rising across the board. Let's have a pre-negotiated rate with volume that applies to your entire portfolio. On the opposite side, like we had a company that raised their prices by almost 20%. Over the course of the past 6 months that we're working with. And my rebuttal to them was, hey, why don't we split the difference? Can I sign a longer term? Can I sign a 12-month agreement? Can I sign a 2-year agreement and decrease that price increase from 20% down to 10%? Because the reality is like, I know the companies that we hire today are going to have to raise their prices, but I'm also willing to sign into a longer term if it's a relationship that is one that I think will last and they're delivering value today. And so what a great way of being able to take a 20% price increase down to a 10% price increase just by extending and signing a longer term. Spencer Donaldson, thank you so much for joining us, CEO and founder of Captive Demand and First Future. We'll see you back on here soon. So first, you need to accept that your prices holding flat in 2025 is probably not realistic if your costs are rising. For local service businesses, this is med spas, this is salons, this is IV therapy clinics, fitness studios. This is a moment to review your service menu and identify where you can adjust pricing without losing clients. And you need to consider things like tiered pricing, membership models that lock in recurring revenue while giving clients perceived value. If you're running an online service business, a coaching course, membership community, take a look at pricing tiers and whether your lowest tier is still profitable. You might need to sunset your low margin offers or bundle them into higher ticket packages. For B2B service firms, professional firms, agencies, raising rates is harder because clients expect predictability. But if your costs are up, your rates need to go up as well. And you want to frame it as a value conversation, not a cost conversation. And you want to give clients plenty of advance notice. Here's where a CRM connected mobile app or a client portal can help. If clients can see the full scope of what they're getting, all the past session, real-time analytics and dashboards, they're more likely to accept a price increase because they feel that it's more of a relationship and less of a transaction. That's what I'm talking about earlier, where I have vendors that are increasing their price, but because I look at it on a 12-month term, on a 2-year term, on a 3-year term, I'm looking at it from more of a relationship angle. Today's show is brought to you by Viton One, the AI native platform that turns your CRM and tools into a custom branded mobile app and client portal. If your clients are bouncing between links that they have to save, emails, and DMs, Viton wraps it all into one mobile app on the home screen of their phone so that they can book, rebook, and stay engaged without you chasing them. To see how this works for local service businesses or online experts, B2B firms, head to Viton.com. That's VYTEN.com and set up your free strategy session. All right, let's wrap it with a story that shows that AI is not actually replacing workers. It's helping small businesses actually hire more of these workers. For AI today, doubling headcount is actually what's happening. And this is why small businesses are all in on automation and still hiring. And finally, if you've been worried about AI killing jobs in small businesses, the new data is actually saying that the opposite is happening. AI adoption among small businesses has actually more than doubled over the course of the past 2 years, and businesses are using it to actually hire, not fire. The U.S. Chamber of Commerce just released its 2025 Empowering Small Business Report in August, and the findings are actually pretty striking. AI adoption among small businesses has jumped to 68% in 2025, up from 40% in 2024, and just 23% in 2023. That's nearly a tripling in 2 years. But here's the kicker. 82% of small businesses that use AI increased their workforce over the past year. That's according to Fox Business. The technology sector leads at adoption at 77%, followed by the financial services at 74%, entertainment and media at 65%. But even traditionally conservative industries like construction and manufacturing are actually adopting AI at 47 and 46% respectively. And most businesses, 63%, are relying on externally developed AI tools like ChatGPT, like Casper, or industry-specific automation tools rather than building custom ones. Now, 80% of small businesses say that they've ramped up AI hiring plans after learning that their competitors are actually using it. And this is suggesting that AI adoption is not necessarily a competitive necessity, is not just a nice to have anymore. So if you're a small business owner, what does this mean for you? It means that first, you're not experimenting with AI yet, you're falling behind. For local service businesses, AI can actually automate things like appointment reminders, follow-ups, review requests, even personalized rebooking messaging based on your client history in your CRM. That frees up your front desk, that frees up your receptionist to be able to actually focus on high-touch client care instead of chasing no-shows. If you're running an online service business, a coaching business, course, a membership, AI can actually draft email sequences, create content outlines, summarize client progress, and it even can recommend next steps on an individual client basis. B2B companies, professional services firms, agencies, AI can streamline proposal writing, client onboarding, project management. It can cut hours off of repetitive tasks. And this is a key insight from the data that AI doesn't replace people. It actually amplifies them and makes them more efficient. Businesses that are using AI are actually hiring more. Why are they hiring more even with using AI? It's because they're growing faster. They're serving more clients and they're operating more efficiently. But as the business grows, they still need to hire more people to be able to support the increase in the workload of those clients, even with the efficiency with AI. And those AI tools connected to your mobile app, connected to your client portal, they're not just automating tasks, you're creating a seamless client experience that feels personal, even when it's powered by automation. All right, 3 quick stories to wrap up the day. Shoppers just spent $44 billion online in 5 days, but they're leaning into debt to be able to actually do this. National Retail Federation reports that 203 million consumers shopped during the Thanksgiving weekend. Online spending hit $44 billion between Cyber Monday and Thanksgiving. This is up 8% from last year. You might not feel like it, but 8% increase, pretty dang good over Cyber Monday and Black Friday. But The surge does come with a catch, though. Many low-income shoppers are using buy now, pay later. Adobe actually predicts that this is driving $20.2 billion in holiday spending this year, up from 11% last year. Service businesses, this signals that clients may have less discretionary income in January and February as that holiday debt actually comes true. So you want to plan your Q1 promotions accordingly. Consider offering flexible payments. Consider offering membership options to be able to smooth out your cash flow. Small businesses are betting on joy, not just deal. This is working. Wall Street Journal reports that small retailers are deploying a counterintuitive holiday strategy, fewer holiday-themed items, more emphasis on creating joy and memorable shopping experiences. So instead of competing on discounts, they're actually focusing on personalized service. This is things like curated gift guides, it's in-store events that build community. What's the takeaway for small business and service businesses? Clients don't always buy based on price, and they choose based on experience. So if you're running a local service business, you really want to lean into the relationship right now. Host client appreciation events, send personalized thank you videos, create an exclusive VIP experience. An AI-powered app or a client portal can actually help you track client preferences and milestones so that these interactions actually feel custom and not generic. But dynamic pricing has gone now mainstream. Your clients are noticing. The New York Times actually reported this week that Instacart is now using algorithmic pricing that actually charges different customers different prices for the same bottle of milk from the same store. And this is all based on their shopping history and their willingness to pay. It's the same model that airlines have used, that hotels have used, but now it's spreading to groceries and everyday services. So for service businesses, that raises a question. Should you experiment with dynamic pricing or personalized offers? And the answer really depends on your market. B2B firms, professional services can use pricing tiers based on things like urgency, like scope, like client history. Online services businesses can test dynamic coupons for early bird signups or VIP upgrades. Just like you want to make sure that your CRM tracks every single interaction and the pricing feels fair. The number one thing, though, is transparency and whether this actually builds trust with your business or whether it actually hurts the trust with your business. 45% of small business owners say inflation is their biggest challenge right now, and they're not wrong. A new poll from MetLife and the U.S. Chamber of Commerce found that 45% of small business owners cite inflation as their top challenge heading into 2026. That's according to The Hill. Despite a slight uptick in optimism, cost pressures really are remaining a dominant concern, especially for businesses that can't pass price increases onto clients. So what's the takeaway? If you're a small business owner and you're feeling squeezed, you're not alone. You need to focus on what you can control. Automate low-value tasks. Tighten up your expense tracking, tighten up your CRM to identify your highest value clients so that you're not wasting your time on low margin work. And if you can, shift towards recurring revenue models that stabilize cash flow, even when the economy is unpredictable. That's it for Always Booked Live. I'm Vincent Fanvan. We'll be back tomorrow with all the news and all the ideas that keep your calendar and your client relationships always booked. If you want to see what a Vyton mobile app or a client portal can look like for your business, head to Vyton.com. That's VYTEN.com. Thanks for joining us. We'll see you tomorrow.